As you can probably gather, Izabella is having some tech issues, but I'm going to see if I can bring her up from the audience. That might help. How do I... Anyone? Oh, yes, invite guests. Sorry for this, everyone, but we didn't want to keep you waiting anymore. And Izabella, if you can hear me, I've sent the invites again. In this day, I think this would be smoother. Anyway, I'm going to start talking. Izabella is going to get this figured out because she does have plenty of experience with this. Sometimes any of you who've worked with Substack know that it sometimes goes totally squiffy. So, hi, welcome to the second episode of Monetary Forces, a joint live stream project between Izabella Kaminska and myself, in which we pull on our big picture lens and also nerd out on the details that we really love to bring you insight you're not going to get elsewhere. And what kind of insight? Insight on the focus that Izabella and I share, which is the intersection of technology and finance. We're both very interested in how new technologies are influencing how the monetary landscape is changing, how it's changing, impacting geopolitics, and how this is going to affect society at large. Now, let me see if I can... Isabella's trying to reach me. There we go. Sorry, Isabella, I couldn't pick that up. It says the live stream has ended. That is very strange. I will try inviting you again one more time. And it should work. It should. Sorry, everyone, bear with me 1 second more. Okay, Isabel, invites resent. Now, this is as you can tell, we are clunky at the moment because we're keeping this as simple as possible. We're both very busy and we haven't got time to do the slick productions that I know you're probably all used to on other similar podcasts that you listen to. We also don't have time really to take care of the distribution. We are working on getting it uploaded to YouTube and our respective newsletters, of course, and also various podcast distributions. But bear with us because, again, we're new at this and we're just going for the whole amateur look, which is kind of hopefully keeps it authentic. Now, this is a pilot series. It's going to run until the end of July. Then we're going to take a typical European summer break, hopefully back in the autumn. But we have so much to talk about in the meantime. The format is the same as last week. We're going to discuss a couple of news items that caught our eye. And then I'm going to go deep into a paper that I have been wanting to get my teeth into for quite some time. A topic that I have spoken about often publicly and also written about, and a topic that I am changing my mind on. It's about are stablecoins money? Now, feel free to throw in any questions. Obviously, I'm going to ignore any that are to do with prices or the macro environment because that's not the topic of this podcast. But do feel free to engage and do feel free to let us know feedback as well. By all means, tell us that we do need to get better at the streaming business. We really know. I'm going to hope that Izabella gets it figured out, but I'm going to barge on. I'm going to start with something that caught my eye this week, and that is a flurry of announcements of international stablecoins that are not based on the US dollar, also not the euro. We've seen quite a few euro announcements recently, but I want to talk about other further downstream stablecoins. We saw just over a week ago. Oh, hello, you have joined us.
Oh, something has happened, but I can't see anything. Can you see me?
A gorgeous background today, but now we can't hear you, which is really weird.
That's so weird because I'm on my phone now.
If anyone watching has an idea of what Izabella can do to get her audio fixed, do please let us know. Okay, I'm going to keep on going. Yes, sorry. Stablecoins, downstream of the United States dollar and downstream of the euro. About a week ago, Allunity launched a Swedish krona stablecoin. Last week, there was a big move on the Japan ecosystem with the launch of JPYSC. Now, this is a big deal, actually. It's only the second registered, regulated a stablecoin to launch in Japan since Japan passed the stablecoin regulation. They were the first major economy to do so. Back in 2022, it went live in June 2023. The first launch under this regime didn't come until more than 2 years later, in October of last year, where a payments company launched a retail-focused stablecoins with some very significant caps on transactions. So obviously, pickup has been fairly muted. Now we have the first trust bank-backed stablecoin issuance, and it's issued by SBI Holdings, which is one of the largest Japanese financial services conglomerates. And this is a big deal because SBI Holdings has been very involved in the token ecosystem and tokenization. It has a crypto exchange. It has just bought another one. It has distribution, in other words, and also has the embedded use cases. It's already talking about setting up lending protocols, things that sort of thing. So there's a lot of potential here, but the Japanese ecosystem, Japanese regulators are so conservative, so conservative. They make the English ones look daring in comparison. So Izabella is commenting, sorry, no, we can't hear you. I'm really sorry about that. That is really strange. Oh, you can all hear Izzy. Oh, Izzy, don't tell me it's my end. I'm never going to live this down. That is so strange. It is, yeah. Thanks very much for pointing that out. Yeah, I'm never going to live this down. Izzy, I'm so sorry. Can you join back in and then I'll hop out? Maybe. Sorry about that, everyone. Can you all still hear me? Okay, TF is saying he can only hear me, not Izzy. This is very clunky, isn't it? Okay. Izzy, I can't see you though. Are you in? Well, I'll yeah, okay, good. It's not just me that can't see her. Izzy, we can't see you. I've reset the invitations. You should be able to get back in with those. And you can all still hear me, which is good. Okay, I'm going to continue. Stable coins, getting distracted here. The bigger point, though, isn't so much that Japan now has, wow, 2 regulated stable coins, or that Sweden has a krona stable coin. It's what's the use case for these stable coins? They're not going to be used much as cross-border trade settlement currencies because that's the dollar's role largely. And all of these countries do have very sophisticated internal payments rails. So what really is the clear use case for stablecoins beyond the dollar and maybe the euro, because that is a trade settlement currency to some degree? My theory is that it's largely going to be used for FX settlement. And this is where I think we're going to see some huge leaps forward in how the FX markets work. Right now, they're efficient. Everything sort of has to go through the dollar, though, for liquidity and also for prices, and for costs. But if the large institutions start to increasingly use on-chain pools in which the FX is automatically handled by a type of rebalancing, then that is a very strong use case for stablecoins outside of the immediate ecosystem, the dollars and the euros.
Can you hear me now?
Hi, I still can't hear you. So you're in. I'll sign out, although if I sign out, that might end the live stream.
Why don't we just you talk and then let's just see if anyone in the chat can tell us if they can hear me. And if yes, everyone can hear me. So the only problem is we can't hear each other. You guys can hear us.
But I can hear you now. I can hear you now.
Okay, so we can all hear each other now. Fantastic.
I'm gonna
Oh, what
put
a
down on my
disaster.
no, and my fault and sincere apologies to everyone. And Izzy, I can't imagine what I did to your stress levels there.
It's
How's your
okay.
day going
I'm
so far, by
doing
the way?
math.
How's your day going so far?
Sorry?
How's your day going so far? Well, it's
Fine.
going fine, right? Until this.
Fine until no, it's fine. This is the I am like a magnet towards tech problems. So anyway, I don't know what you've already recounted in the meantime, but I imagine
Started
you've
on
done.
the foreign stable coins, and everyone listening, that sound you hear is me chucking my mic out the window. There are some complete downstairs as a
Oh.
result.
Don't worry. I
Yeah.
was just having a I was just like testing my own mind. But what I wanted to say is, well, I just wanted my contribution today was very minimal. I wanted to flag that the Russian central bank has also announced a consultation on stable coins, which I think is very interesting. Not least because they have been a little bit cold and hot on crypto in general. Like in some cases they like it, in some cases they don't like it, and it looks very much like in terms of I haven't read the full paper because it's in Russian. But what I could determine is that they want a very compartmentalized approach to stablecoins, which is predictable, really, in that they don't want to allow stablecoins for intra intra-system settlement. They are more interested in cross-border. So this comes on the back of obviously one of the big Russian stablecoins having been targeted in sanctions and freezes by authorities and agencies. So now they're exploring like a more official version on that front. So that was my contribution towards local
And
currency.
it's extremely relevant. I briefly went over the Swedish krona stablecoin and also more interesting the Japanese launch, which transformed the Japanese landscape. But the point I was trying to make was, what's the use case here? They're not going to be used much for cross-border trade because that's still going to be the dollar, and they have lively and efficient internal payments rails as it is. So the use case isn't very obvious, except perhaps in FX conversion, which right now everything goes through the dollar. But imagine if there were on-chain pools that various global corporations could use. SBI Holdings is obviously a key example of a company that could use some internal decentralized pools just to make the whole, not even decentralized, more automated pools to make the whole conversion part easier. Now, with the Russian stablecoin, there are different use cases there because Russia is largely cut off from the system and it's not going to be part of any dollar stablecoin pools unless, of course, there's an agreement in the back rooms before the war ends. But it does have a difference because it does want trade settled in rubles because it has difficulty settling everywhere else. The key would be, is China going to be interested in holding ruble stablecoins?
Yeah, exactly. But I also, and I'm speculating here. I think what's really interesting about Russia, beyond obviously everything else, is that they were quite quick to adopt perpetual futures on their Moscow exchange. They were the first, I think, of major exchanges beyond like what happens in DeFi, and one of the applications for perpetuals was in terms of ruble cross rates versus other currencies. This was largely to synthesize a cross rate for domestic entities who need to hedge continuously, like, even though they're frozen out of the US dollar system, there's still sort of internal hedging around hypothetical positions versus the dollar. So perpetuals were being used quite officially on the MOEX exchange. And I do wonder if this new consultation will somehow be a bridge between those perpetual rates domestically and cross-border, some sort of cross-border positioning. But I mean, this is speculation on my part.
And then you could see something similar happening perhaps in Japan, which is trying to position itself as a trading hub. I mean, it has competition with Singapore and Hong Kong, but it does want greater regional trade with its allies in the area, and it's going to need some clear settlement capabilities for that. You're right. The hedging opportunities for stablecoins could perhaps be interesting. But again, stablecoins in Japan, they're not going to earn their issuers very much. They are now, as of a couple of weeks ago, allowed to hold half of their reserves in Japanese government bonds, but the 3-month is yielding less than 1%. So there's a lot of income there. But that brings us a nice segue into the next item. Izzy, you wanted to mention something about BIS and FX.
Yeah, so this is a little bit off center, off stablecoins specifically, but the BIS published their annual economic report. They always issue it in chunks. So we went through the paper on stablecoins last week, but there's another paper, a broader paper, one could say, on high public debt and shifting financial markets challenges for central banks. And buried in that, there's one of the BIS's favorite topics, one of the areas it likes to worry about the most is the, um, what's going on with cross currency swaps, FX swaps, etc., which it sees as a area where a lot of risk can be accumulated, not least because of the role FX swap rates played in the financial crisis of 2008. Um, and of course, no surprise, the BIS warns that, again, these exposures are growing quite significantly. There's some very interesting charts. I've put them on the peg. So do go in yesterday's daily peg. So do go and check them out. But the key story is that the exposure has shifted from conventional banks to so-called NBFI, so non-banks, hedge funds, etc. And from that perspective, I think they've said that the FX derivative market has expanded rapidly since GFC, etc., etc. Outstanding FX forwards and currency swaps reached about 130 trillion at the end of 2025, up from 50 trillion in 2009. Growth has been the fastest among financial counterparties. Most contracts are short term, roughly three quarters mature within 1 year. So this is like absolutely gargantuan sort of like exposure here. And I think the reason it connects to what we're talking about is just that when you go into the report, they also talk about a sort of structural dollar shortage in the market more broadly. So these FX swaps are used in many ways to mitigate lots of regional exposure to the dollar, which obviously gets more and more you know, precarious when the dollar goes up, as it is now going up. So I think it's just something to keep an eye on because it feeds into how stablecoins themselves might, be impacted through a sort of rush of liquidity, well, a rush on dollar liquidity more widely if and when dollar funding strains emerge. But this time in the non-bank sector.
Which is a good segue into the next topic about banks and non-banks. And this is the debate around skinny master accounts. Now, skinny master accounts are an idea that was proposed by Federal Reserve Governor Chris Waller last October. And the idea is to give non-banks access to master accounts at the Federal Reserve, but with restrictions. No lending, no intraday lending, no interest rate on their deposits, and also no discount window borrowing. In other words, just the pristine, pure payment rails, which of course any payments related company would absolutely love because that would make their payment service as good or as reliable as those of banks. Now, understandably, the banks are not happy with this idea. In May, the Federal Reserve released a formal proposal for comment, and last week, the the Financial Services Committee held a hearing on the matter. And obviously, the bank lobbies were there in force, very unhappy with the idea because they do see this as, of course, deposit erosion. If non-banks can have access, even limited, to accounts at the Federal Reserve, then that does make them a much stronger competitor. They could be luring away some deposits. And lawmakers are insisting that they are very concerned that this would weaken the Bank Secrecy Act, would weaken the controls about anti-money laundering and illicit financing. That part's actually not true because skinny master accounts would insist on the same level of controls as banks have. But the point the bank lobbies are making is that these entities don't have bank regulation, so why should they have bank privileges? Whereas the proponents of the idea are more of the mind that this would simply make payments, one, more innovative, and two, safer. And what could be wrong with that?
Exactly. So should we? So now, as per our promise last week, we aim to always read something properly, but on the assumption that there's a lot of stuff coming out. Journalists are commenting on things, but often not reading them from beginning to end. And we're taking it in turns to dive deep into something a little bit more extensive. And this week, Noelle has done the deed. So tell us more about what you've been looking at closely.
It's a good segue actually from the previous topic, and well, pretty much from everything else we've been talking about so far today, and that is are stablecoins money? And obviously, accounts at the Federal Reserve would help, but that's only a very small part of the picture. Now, anyone who's been reading my work and also listening to me in public, I've been saying that, listen, if we think stablecoins are money, then what makes them not money? And I realize now that there's a big part of the equation that I actually have been overlooking. My caveat is I'm not a lawyer, but I am interested in how law shapes our behavior, and nowhere is that more obvious than in capital markets. And stablecoins are a key area where the law is evolving, and therefore our behavior is evolving also. So I want to dive into the nuts and bolts of what makes something money and how this applies to stablecoins. And I'm going to do so by talking about a paper that was published a few months ago and is pending publication in the Yale Law Review by three well-known law professors, Yeshe Yadav, Christopher Odinet, and Andrea Tossato, and it's called The Moneyness of Stablecoins. So you can understand why I lunged at that paper as soon as I saw it. And that's well written. It comes at the money concept from an original angle, and it's effective. It opened my eyes to the web of legal protection that money needs. Now, the authors start off by tackling the issue that while we're told what money does, it acts as a unit of account, a medium of exchange, and a store of value, there's little exploration of what makes something money-like. And this is where the legal framework comes in. The legal framework is necessary for something to have money characteristics. This is something that I hadn't fully appreciated. It's also relevant because money is changing over the centuries. It has often changed form and format, and we're witnessing another similar evolution, yet there's still not quite the exploration of what is it we're dealing with here that I think we're going to need to really move to the next level. So what characteristics does money need to have to be considered money? Now, it's worth pointing out that the authors are law professors, they're lawyers, professors of financial regulation. And so that's the lens that they look at this through. Economists have a different lens through which they see money, and also consumers have a different lens through which they see money. But the law does matter, as we will see. The paper defines 4 characteristics of moneyness. One is legal state. The other is safety, discharge, and negotiability. I'll now briefly, for the sake of time, go through each and how they apply to stablecoins, and then there's a kicker at the end. The authors look at whether stablecoins satisfy any of those 4 characteristics, and the spoiler is they don't, none of them. Legal state. Does the law define what you're exchanging as money? Now, fiat money works because of the legal system underpinning it. Now, strangely, it's not about legal tender, as we'll see in a second. Legal tender means that the money that you have in your hand has to be accepted at the store. That's the definition of legal tender. I mean, that's part of it, but that's not the whole picture. For now, the law recognizes 2 types of money. You've got public money, which is the currency in your hand, and it's the accounts it's the central bank reserves, currency central bank reserves. That's public money. The rest is private money. Banks and non-banks create private money. Now, most money today is private money by an order of something like 10 to 1. But the moneyness of public money is codified in law. That's legal tender. Private money, including that issued by banks, that's not legal tender. In other words, nobody has to accept an electronic bank transfer. But for convenience and because of the legal structure underpinning this kind of service and because of demand, most do, but they themselves are not technically legal tender, but considered money, largely because banks are protected. Now, going down the scale, PayPal in the US, many use Venmo. That's not considered money at all. Us consumers don't really care, but we should perhaps give more thought to just how safe is this money that we're dealing with. Bank-to-bank transfers have legal protection. PayPal-to-PayPal transfers actually don't, beyond contract law. And as you all know, anyone who's read a contract, that can be very stiffy. Now, when it comes to stablecoins, the same. There's no legal protection of stablecoin transfers there. The Genius Act does not codify stablecoins as money. Technically, they are controllable electronic records under the Uniform Commercial Code, not legal tender, no bank-like regulatory framework, no public protection, and acceptance is discretionary. So Genius does nothing to enhance the moneyness of stablecoins, nothing to enable them to satisfy their action as unit of account, medium of exchange, or store of value. It is limited mainly to reserve requirements and redemption protection, which brings me to the second characteristic, safety. For something to be considered money, it needs to be seen as safe. Public money, totally safe. Private money, safe if the regulatory framework holds up. So we can argue that stablecoins are safe. I mean, that's one thing the Genius Act tried to do, but safety is not enough. US T-bills are safe, but they're not money. Anyway, the Genius Act didn't really guarantee the safety of stablecoins. There's the vulnerability of third-party custodians. And at the end of the commercial banks holding reserves, as Circle found out in March 23, when Silicon Valley Bank collapsed. So there's not a lot of protection around where the stablecoin reserves are held. The assets are safe, sort of, but there's nothing like the safety that public money has or even that private money has. So holders have to assess both issuer and custodian solvency. It is not viable if stablecoins are to be always accepted as money. And of course, no one does that, but we should, because the Genius Act does contain bankruptcy provisions, but the authors of the paper make a compelling case for why they are incoherent and unworkable. There's a lot of detail into that, but I've gone through the detail, and they're right. The Genius Act has really bad bankruptcy protection for stablecoin issuers and therefore for the holders of these stablecoins. Another overlooked aspect of safety is the redemption right. Genius is vague on this. It guarantees smooth and swift redemption at par, but it's not clear on who has that right. Does it accrue to the token holder? Does a stablecoin holder have the right to redeem? Or does it only accrue to the account holders at the issuers? And that's not everybody. Tether has about 800 account holders. Circle has, I think, double that. But most stablecoin users don't hold accounts at the stablecoin issuers. Most stablecoin users don't have any relationship at all to the issuers of these tokens that we are treating as money. And, that's not really safe. The third characteristic of moneyness is discharge capacity. And that has two components. For something to be discharge capacity means that if I hand you these dollar bills, I am satisfying my obligation to you. If I send you stable coins, I am satisfying my obligation to you. This has two components. One is acceptance. For me to discharge my obligation, you have to accept what I'm handing you. With dollar bills, you have to accept it by law. With stable coins, not so much. The other component is finality. If I hand you the dollar bills, are we done? Yes. If I send you stable coins, if I hit send on my phone, are we done? Not necessarily. So stablecoins fall short on the acceptance characteristic. Nobody has to accept stablecoins, and not that many establishments do. And it also falls extremely short on the finality characteristic. If I send stablecoins, I don't know if the transaction is final, if I have discharged my obligation. Stablecoins, even if Genius did codify finality in stablecoins, it wouldn't really matter because different blockchains have different mechanisms and work in different ways. On some, stablecoin finality is probabilistic, on some it's determinate. It very much depends. And also, stablecoins are not fungible. If I'm going to accept USDT on Tron, I'm not necessarily going to accept it on some of the others. Again, there's a lot of opacity in whether stablecoins can ever be recognized as money because they're not even fungible, which money it should be. We can all agree on that. The final is negotiability. Now, this is kind of a fuzzy legal term, which doesn't necessarily mean what you think it means. Negotiability in legal contracts means that I can accept these dollars without worrying about who held them beforehand. I can take payment in dollars, and I don't have to worry if these dollars were stolen from Izabella a couple of months ago. Can't really say that so much for stablecoins. Sort of. If I take a stablecoin payment, then I can assume that those stablecoins are unencumbered. But again, not necessarily, because Genius Act doesn't really say very much about stablecoins being used as collateral to open custodian accounts, for instance. They can't be rehypothecated. We know the reserves have to be pristine, but it doesn't say much about stablecoins being used in encumbered situations that would, theory, make it not a good payment. In other words, you wouldn't be able to assume that the stablecoins you're receiving are yours 100%. And this is even not taking into account the fact that they can be frozen at any time from the stablecoin user. Sorry, getting hiccups, bad timing. So stablecoins, according to those four characteristics, are not money. Should I take a breather and see if there are any questions, or shall I plow on to the
Well,
remedy?
I have some questions. I find it's really interesting. The Uniform Commercial Code aspect of money has fascinated me since, I guess, gosh, roughly 2015, when I wrote a piece for the FT called Bitcoin's Line Problem. Lean line, I'm not sure how you pronounce it. Again, caveat, I'm not a lawyer either, but as it was explained to me, one of the reasons lawyers thought Bitcoin would never become money is because of this, I guess, this fourth variable you discussed just now, the idea that you have to have kind of cleared funds totally, and if once the money moves to the next person, that's it, it's yours. There's no claim on that money anymore, even if it came from even if it was stolen, the claim ends. You have to go and retrieve it in some other way. You have to go after the person who stole it from you rather than the money itself. So the responsibility ends with the transaction, and it just passes on to the individual. That's how it was explained to me. And so it's very interesting, and I guess not surprising that the same element applies to stablecoins. But what I do find interesting is this acceptance idea. And I don't know if that's a quirk of US law specifically or Uniform Commercial Code, because my understanding, at least in the UK, for example, is that there is no guaranteed acceptance element in the UK, in that you can't force a retail establishment to take sterling and not some other token or asset to settle a debt. You can, at least my understanding was, in the UK, you have, as a private individual, the ability to pick and choose and negotiate whatever currency you can. It just so happens that because everybody pays their taxes in sterling, the general path of least resistance and the most practical token to accept is sterling.
That would make sense. On the US, on the commercial code aspect, so I was just trying to find, is Bitcoin, does it fall under the UCC? Stable coins, according to the Genius Act and previous, they do, under the UCC, as I mentioned, they are a controllable electronic record. That does mean they have negotiability. That does mean, because it's controllable in theory, you can accept it and no one's coming for you to reclaim those because they were part of a hack, last year. So that's something that the Genius Act does clear up quite well. And so negotiability is perhaps the strongest of the four, but it's not enough. Just like safety on its own is not enough. Just like even the legal state is not enough. For something to be considered money, it needs to be pretty solid on all of those. And my big takeaway is that the legal framework matters a whole lot more than I appreciated before reading this paper.
I mean, I would certainly agree. I mean, I've been fascinated with the sort of legal quirks that come up, especially in terms of the waterfall structures and bankruptcy, insolvency. All that stuff is also super interesting. It's certainly. Does the paper go on? Does the paper specify anything specifically about the the rights you have or don't have as a token holder in the event of a bankruptcy of a bank institution that issues stablecoins? Because my understanding was that was one of the key areas of friction when they were negotiating Genius, that the banks were very keen to not allow this super seniority element of token holders if they were to issue tokens themselves alongside, say, deposits or tokenized deposits.
Well, as with any massive compromise bill, Genius does give super seniority to token holders, but it fudges who those token holders are. Again, are they you and me for our USDC holdings, or are they the account holders with Circle? Genius is unclear on that, and it does matter. For instance, if you and I hold USDC and Circle, God forbid, it will never happen, but God forbid, runs into issues, can you and I redeem our stable coins? We're not going to be able to go to Circle and redeem them. Circle has no obligation to redeem to you or I, even if we meet the minimums. It's not enough. And we could try and sell our USDC on Coinbase, or even use a decentralized pool, but they are under no obligation to accept our order. So you and I do not have redemption guaranteed according to the law as it is written at the moment, which again creates a two-tier stablecoin ecosystem, same token, different rights. That also does not help the moneyness aspect.
Although I think there's a different element if it's a bank issuing the stablecoin. So that your scenario is obviously if it's a non-bank like USD, like Circle. But if it's, say, a JP Morgan or a Barclays, let's stick to US banks. The understanding I had was that in say, not that JP Morgan would ever go down, it would be the last bank on earth to go down, but although stranger things have happened, famous last words. But the idea is that relative to other account holders, if JP Morgan has issued stable coins, then the underlying assets are sort of segregated and compartmentalized specifically for those token holders. In that case, the token holder, as far as I understood, had a sort of super senior claim over, say, usual senior secured lenders to JP Morgan. So that element of collateral in the bank is kind of ring fenced in that scenario. And that is what I think a lot of banks were a bit worried about, because if they were to issue stable coins, then in a crisis you would see sort of people moving deposits, even at Barclays, away from, say, tokenized deposits over to stable coins, because it would give you a sort of first dibs on the underlying collateral and allow you to jump up the ladder in terms of who gets first claims over the underlying.
In theory, but the way Genius is worded doesn't, unfortunately, really work like that. Now, first of all, banks have a separate bankruptcy regime. So do non-bank trust issuers, such as, a lot of the issuers that we have today. They have a separate bankruptcy regime also. But the way Genius is structured is the reserves are separate from the estate of the firm that is entering bankruptcy, totally separate. So stablecoin holders, in theory, get paid out in full, but it gets contradictory where Genius Act says, fine, but there's also a stay extended to the reserves in the event of bankruptcy against any action. That's standard in bankruptcy procedure, but you can't extend to the reserves if the reserves are separate from the estate. In other words, you're mixing up your legal entities here. Also, if there are not enough reserves, God forbid, for all the stablecoins, they get super seniority on the remaining assets of the issuer. And we can't rule out a scenario where that takes care of everything else that the stablecoin issuer has. And then how do the lawyers and the bankruptcy executors get paid when there's nothing left to pay them? They're not going to do it pro bono. So it's messy. There's really not a clear bankruptcy regime in Genius. And that is something that should worry stablecoin holders. And in my opinion, although users don't really think about bankruptcy, and God forbid we ever should have to, it's something that we have to keep in the back of the mind. And also, again, this brings into the redemption rights. Does that affect the right to claim on the reserves? That's also not clear in the Genius Act. But the authors of the paper, another reason I really like this paper is that it was not about stablecoins are not money, therefore you should be very careful and not use them. It wasn't that at all. It was stablecoins right now are not money, but here's how Genius can be improved. Here's how the law can be improved to make them more money-like. The authors are all very excited about the innovation potential here, and they're really trying to be helpful. And here's what it would take for stablecoins to be considered money in the financial landscape of tomorrow. It's not a warning paper, it's a prescriptive paper. And some of the 5 remedies they recommend are: 1, grant qualifying stablecoin issuers access to Federal Reserve master accounts, none of the skinny business, master accounts. Make them pristine in terms of payment quality. They would also give the Federal Reserve insight into reserve capacity. It would reduce any risk of bank runs. It would fix concern about custodian health. In other words, it would solve a lot of the problems the paper was talking about. 2, and this is very interesting, industry-provided insurance, much like FDIC, but for stablecoin issuers, paid for by the industry itself. 3, redo the insolvency rules. As I mentioned, they're an absolute mess. Some clarity there would be appreciated. Maybe that will come through in the rulemaking that's currently undergoing. I haven't seen anything concrete on that, but maybe I've missed it. 4 would be define finality. When is a payment good? When is the obligation discharged? And 5, clarify the redemption rights. It's not practical for Tether, for instance, to have to honor the millions of wallet holders should they want to redeem. That's just not practical operationally, and also there's no way they'd be able to control for illicit use, etc. So it does make sense to channel it through approved, controlled, KYC'd accounts that are responsible for the checks, but that should be clarified in the code because it does create a 2-tier system.
Of course, banks would be not very happy about the idea of stablecoins getting access to any master accounts at the Fed, because they would just argue, well, then what's our privilege? we have we have much higher capital requirements. It just
Much
the
higher.
cost of business is just incrementally higher for us.
And they're less profitable. Higher costs.
And
Yeah, but they just don't make as much money as Tether does, for instance, with 300 people. So yeah, banks are not going to like this at all. And we have to acknowledge that banks are a very powerful political force in the United States. But then again, think how far the regulation has come despite fierce opposition from the banking lobbies. That's one of the reasons why the Clarity Act is so important. I mean, the agencies can do their rulemaking and push forward tokenization and crypto exchanges, etc. anyways, but if the government changes, if the administration changes to a more hostile environment, a more bank-friendly environment, then that could all be unwound. That's one of the reasons why Genius Act was such a big deal and why Clarity Act would be a huge advantage as well. Basically, to enshrine it in law. It's very hard in the US to undo a law. It's very easy to undo a rulemaking, but it's fraught because we can't deny there are risks. I mean, you and I have talked about this before, there are risks to stablecoins, and any novel product is obviously going to have issues that none of us have thought of. And let's face it, it's important. I'd say, systemic, and you don't want to mess around with financial plumbing, especially of the largest capital market in the world.
Absolutely. So perhaps we invite some questions from the audience if we still have any. Because I mean, you have how long is the paper, Noelle?
I don't remember. It's readable. It's a good read. They're good writers. It's a bit repetitive. I mashed up the order quite a bit, but I learned a lot. And any paper that teaches me a lot is definitely worth
Have you
revisiting often.
written about it on your in your newsletter?
Not yet. I wanted to break it here first, but I might. There's so much in there to pull out that I probably it will feed much of what I do think about going forward. Because again, stablecoins being money, and you and I've talked about this, it's important. And while I got into the crypto industry back in 2014 because here's an opportunity to totally rewrite how finance works, and that's exciting, I am still as excited today about that as I was back then. And to see it actually happening is just absolutely mind blowing. But it's also fascinating. I realized this even back then when I realized that Bitcoin wasn't going to be used for payments. The obstacles are as interesting as the potential because the obstacles teach you so much about the current system. You know the saying where to understand how something works, you need to break it. Well, we're sort of seeing that roll around the world in terms of financial incidents, tensions, concerns, etc. And here we have a new tool in the box, and we're still figuring out what its impact is going to be. This is why you and I do what we do. That's why we focus on this fascinating sector. But the moneyness of stablecoins is key, and I'm pretty sure we're going to be hearing a lot more about this in coming months. The hearing last week about master accounts is just the start. The rulemaking that we've been seeing coming out of the various agencies around Genius, again, are going to be adding on to that. And Clarity is also going to have some things to say, I think. And all of this tying into the fact that there's a new chair of the Federal Reserve who wants to rethink the rules. I don't think we've had this amount of potential change in global finance in a generation.
And they're all gathering this week in Sintra in Portugal because it's the ECB's annual shindig forum thing that they do. And I understand it's quite breezy there. It's 24 degrees or something. 24, 26. That seems very nice. Which also contrasts with every other time they've been there when I've been told it's super hot usually. So ironically cool for Kevin.
Is that an omen? Is that an omen?
Yes, he's cooling the hot air in Europe. He's the force descending on them to cool the hot air. But
anyway, it's signal tightening.
He speaks tomorrow on a panel with Christine Lagarde and Andrew Bailey, and there's also a session tomorrow being led by Piero Cipollone on tokenized assets with Hyun-Sung Shin, who's now governor of the Bank of Korea. So that's worth looking out for, not least because I do think Hyun-Sung Shin is probably the best authority in all these matters. And I think some of these panels will be available live streamed. So
they are, from what I gather, they are all live streamed, and I'll put the link in the notes to this.
And on that note, I think we've covered. I mean, we started a bit late due to the technical hiccups, but
I'm so sorry, everyone. It's the first time my mic has failed me. Also, the last because I am throwing it away. And Izzy, my huge apologies to you because that must have really stressed you out. I apologize.
No, it's fine. Don't worry. I'm adaptable. But yes, I think that's a good point to close it off on, and we will be back next week, hopefully without any technical hiccups.
For sure.
But please do let us know if there's anything specific that you would like us to go through, because I've got a long list of reports that this podcast is supposed to incentivize me to read from beginning to end. But I'm also open to suggestions, and so if there's anything you just can't be bothered to read, but you'd like one of us to read, just email me. I'm at Izabella, Izabella at the-blindspot.com. And Noelle, which email how was your preferred contact?
Noelle at cryptoismacro.com. Also, you can leave us comments on Substack. Izabella is at The Peg and The Blind Spot. Strong recommends for both. And you can find me at cryptoismacro now.
Excellent. And on that note, I guess it's goodbye from us.
Thanks, everyone, and thanks for your patience.
Take care.